Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. At a state dinner in Beijing, U.S. President Trump and Chinese leader Xi Jinping agreed to the fact that the Strait of Hormuz should remain a free waterway, adding that Iran should not be able to exact payments for the use of shipping lanes. Trump says the Iran war and the status of the crucial waterway have loomed large over his high-stakes trip to China. He is seeking Xi's help to end the Middle East conflict and says he had a positive and productive meeting. Shares of Bird Construction are getting a lift after the Canadian contractor posted higher profit in its most recent quarter. Construction revenue also exceeded estimates, jumping 9% compared to the year before. Bird was also selected as Bell Canada's lead construction partner for its AI data center in Saskatchewan, and also formed a long-term partnership with the telecom giant for a multi-year Canada-wide AI data center build-out. Shares of Brookfield are trading higher today. The investment manager posted revenue of $18.5 billion U.S. in its most recent quarter and reported total assets that surpassed expectations. The firm also plans to combine with its insurance business, Brookfield Wealth Solutions, as it streamlines its corporate structure. Brookfield says it is also evaluating a similar plan for its two infrastructure and two energy entities. And taking a look at the markets for today, the TSX only up above 34,000. It's up by about a little more than a quarter point, being led by consumer staples, healthcare as well. One thing dragging down materials is up by close to 2% right now. South of the border, and green everywhere you look. The S&P 500 pushing 7,500. Dow Jones now up over 50,000, first time in a couple of months, and the Nasdaq also into record territory, up by 0.84%. U.S. President Donald Trump concluded meetings with Chinese President Xi Jinping today. The meetings aim to stabilize trade relations between the two countries after last year's trade war. Here to discuss that and more is Art Hogan, Chief Market Strategist at B. Riley Wealth. Art, thanks as always for joining us.
Morning, Roger. Thanks for having me.
Your thoughts on the meetings that's happened in China? What kind of an impact do you think this is going to have on the markets?
Well, three things. I think first and foremost, I think the reason that there's so many corporate CEOs on the trip with him is the hope that we can hear some announcements of deals. And the deals kind of fall along the line of agriculture for sure. We'd like to renew some soybean purchases that have been stalled out during the trade wars. We'd like to see some orders for Boeing, and China needs a lot of planes, and they can't get them all from Airbus. So that may be the largest of the deals. But also you have NVIDIA on board, and so far we've heard that there are 9 or 10 companies that have been cleared to purchase NVIDIA's H200 chips. So NVIDIA hasn't booked any revenue in China in more than a year. This would be a major uptick for NVIDIA. But I think it's in general, it's a trip where we want to get some support for helping to keep the Strait of Hormuz open or getting it open, and B, kind of leaving the third rail alone and not really getting into any conversations about Taiwan.
And it seems like they've stayed away from that. And how important is that unified front about the Strait of Hormuz between China? And we're seeing oil prices off a little bit again today.
Yeah, China gets about 10% of their energy imports through the Strait of Hormuz. So it's important to them, obviously important to the rest of the folks that export through the Middle East, and important to just about everybody in the global supply chain of hydrocarbons. So clearly that's very important. But getting China's the nod from China, who's a large buyer of Iranian oil, would certainly help in the negotiation process. So to the extent that Pakistan had already stated China had been very helpful getting the negotiation process started, anything that furthers that process gets us closer to that off-ramp we're looking for, which would mean getting that Strait of Hormuz open and perhaps getting the flow of petroleum products back going to more normalized levels over the course of the next month or two.
And is this the markets reacting to that, seeing all the meetings as positive?
So far, so good. Yeah, I think that's a big piece of it. I think NVIDIA is up because of that and the potential for them to get some China revenues, which they haven't seen in a bit. I think the contemplation of having China as a partner at the negotiating table in spirit would certainly be a positive for markets. I think if you look at the other reasons for markets being up today, earnings continue to surprise to the upside, and today's gold star goes to Cisco. Welcome back to the 90s, I guess. But Cisco had a stellar report. Stocks up low double digits here today, helping the Dow move back over 50,000. But in general, if you look at the S&P 500 earnings for the first quarter, they have been expected to be somewhere between 12 and 14% to the upside, and they're looking north of 25%. And guidance for the rest of the year has gone up, not down. So it's been a very strong driver for the market's movements over the course of the last several weeks.
And where does this leave gold, everything that's unfolding right now?
Yeah, I would tell you this. I think gold has showed critical support and has bounced nicely. I think that continues to be the case. The only headwind gold has right now, I would say, is with a Federal Reserve that's likely not going to cut rates for this year. There's a bit of strength in the U.S. dollar. That may be overblown in terms of a headwind, but I certainly think the fundamental demand drivers for gold continue to be very strong. So you have central bank buying, and that has not slowed down. You clearly have the ability for investors to get involved in gold, which, with the ETFs, the GLD, which is a perfect pairing. And you have an aging demographic that would rather be in gold than things like crypto as a diversifier for their portfolio. So a lot of the fundamental drivers are very firmly in place. It technically bounced off some significant support here, and I think the upside is clear.
All right, and the U.S. PPI was out today at 6% year over year. Your thoughts on that?
Yeah, that was yesterday's report, and yeah, 6% is an eye-popping number. The biggest part of that, obviously, is elevated energy prices. But even at the core level, the producer price index has seen a significant elevation here, as had the CPI 2 days ago. I think a lot of that will work itself out if, in fact, we can, in the short run, start to normalize energy prices, which just have been elevated since the start of this war. Remember, WTI was about $65 before the war started. Brent was about, call it $72. So significantly higher than that. It's not as though those prices are going to collapse, but I certainly think a normalization of the flows of traffic through the strait would gradually get us back to something more reasonable in the $75 to $85 range.
All right, and some earnings looks overall the ones we're seeing today. What are your thoughts on them?
Yeah, so far so good. This has been a remarkable earnings-driven market in the face of what is a lot of uncertainty over this war and elevated energy prices. And I think that's a testament to why the market never drew off as much as you'd expect with a war that is going from warm to hot here, and the Strait of Hormuz being closed now for 2 months. So to the extent that the fundamental drivers remain intact, the only problem with that is the longer energy prices stay elevated, the more we're going to see demand destruction, and that likely would cut into GDP and earnings. But I think everyone's making the assumption we're within 30 days of getting the strait open. And
any earnings that stand out in particular to you?
Well, as I mentioned in the beginning, Cisco was a fabulous earnings reporter, not something that I think I've said in about 25 years. So clearly that helps that technology move. And the other piece of the puzzle to keep in mind is the grandfather of artificial intelligence, or the godfather of artificial intelligence, reports next week. So all eyes will be on NVIDIA and what they have to say. But clearly the path of CapEx spending has really started to spread out in driving sectors other than just technology and communication services. You're starting to see companies that are involved in materials and companies that are involved in industrials also driving very significant earnings growth. So I think that this is the first time in about 5 quarters that the S&P 500, which has 11 sectors, saw earnings growth in all 11 of those sectors. So we're seeing a broad earnings growth. Obviously, the biggest percentage of that is coming from technology, but clearly having broad earnings growth has been a significant backstop to this market thus far.
All right, we have to wrap it up there, Art, but always a pleasure to talk to you, sir. Thanks for joining us.
Thanks so much.
Art Hogan, Chief Market Strategist at B. Riley Wealth. When we come back, we'll break down what the latest U.S. retail sales data tells us about the American consumer after this. Prime Minister Mark Carney has just announced a new clean electricity strategy that will amount to the biggest build-out of the national grid in our nation's history. For more on this, we're joined now by CTV's Jeremy Sherrill. Jeremy, thanks as always for joining us. Big announcement, big price tag. What are some of the details that we're learning?
Yeah, Roger, $1 trillion price tag, more than $1 trillion is what the federal government expects this to cost. Now we're talking about a project that will unfold over decades, multiple decades. In fact, most of the targets here are for 2050. But we're looking at a plan through the federal government's clean energy strategy, what they're calling national electricity agenda, their national electricity agenda, a plan to double grid capacity across the country by 2050. By doing so, they'll create, they say, 30,000 jobs by 2028 and another 100,000 jobs by 2050. So a total of 130,000 jobs. The other aim or claim the federal government is making is that by 2050, 7 out of 10 households will be paying less as a result of this for their electricity. So, significant investment in infrastructure moving forward. We'll see projects like new hydroelectricity projects, nuclear projects, renewable projects, maybe some liquefied natural gas projects as well, or expansion to projects. The Prime Minister was pretty clear today. There is no path to net zero in this country without affordability being a priority. And so there are changes coming to the clean energy regulations to allow for flexibility, to kind of bridge the gap, if you will, and ensure that prices are kept low while we see this transition to renewable energies and clean energies in the country. So a significant project here, Roger, that leans on 4 pillars, the government says. The first is building the infrastructure, of course, to get to double the capacity. The second is connecting grids across the country. Right now, a lot of the grids are completely separate in provinces. And so the idea is to expand on and build new transmission lines to connect the grids and be more efficient in the use of the electricity that is being produced. The third is to, of course, hire the people. We talked about those numbers, hire the people to build these projects. And the fourth is ensuring that a lot of the technology that will be required here and the components that will be required for the grid are being built here at home to maximize benefit on our economy. A massive undertaking, something that's going to be happening over the next several decades, Roger, but a significant announcement here for sure.
All right, and what kind of a reaction are we getting from different sectors? Canadian Climate Institute, says the energy sector's been championing the reduction in carbon emissions, which is down almost 60% from 2005. How is this going to keep the momentum going and benefit the economy at the same time?
Yeah, Canada's grid as it stands and its use of clean energy so far has, played a huge role, as you just touched on, in terms of lowering our emissions. Canada has pretty clear targets. 2035, they want the grid to be net zero. Right now, 80% of the energy being produced for the grid in the country is clean energy, non-emitting energy. So they want to close that gap by 2035. And by 2050, they want net zero emissions in the country. The Canadian Climate Institute has pointed to the fact that in order to meet the targets, especially the 2050 target of net zero emissions, that the grid would need to be doubled or even tripled. And so today is, a step. There are many other steps that the Climate Institute says are required to reach that target. But certainly this is a significant step when we talk about increasing capacity for electrification, heat pumps to heat homes rather than, more traditional sources of energy that are not as clean, that rely on some fossil fuels. Electric vehicles is, of course, a huge one, and increasing grid capacity will be required if more people are eventually going to be driving electric vehicles. And then you look at things like AI. There's so much talk these days about AI and the role it's going to play in this government, the role it's playing in business, in the economy. These massive AI data centers that are holding a lot of this data take up a huge amount of electricity, or rely on a huge amount of electricity, and so are putting huge strain on the grid. So these are all things that, if we are to move forward with, will require more grid capacity, and that's the step the federal government says it's taking today.
All right, Jeremy, we've got to wrap it up there, but thanks as always for joining us.
Yeah, anytime, Roger.
Jeremy Sharon from CTV News. U.S. retail sales rose by a modest 0.5% in April, marking the third consecutive monthly increase. Higher gas prices have pushed up spending, but our next guest believes there's little sign consumers are pulling back elsewhere. For more on what this all means, I'm joined by Thomas Simons, chief U.S. economist at Jefferies. And Thomas, thanks very much for joining us.
Of course. Thank you for having me.
Numbers on target pretty much. Any surprises anywhere?
Yeah, I mean, I think that there are some surprises insofar as the data doesn't really show any signs that discretionary spending has slowed down despite the increase in gasoline prices, right? Of course, nominal, retail sales are measured nominally, so you get some inflation component there. And gasoline prices are up quite a lot, so
Hmm.
gasoline station sales are up quite a lot. But, still saw decent sales through eating and drinking establishments, through non-store retailers. So, people still continuing to do their online shopping, and also building materials too, which suggests that, no one is really slowing down on home improvement projects and things like that.
So are these all good signs then?
I have to say so. Yeah. I mean, it's a nice pickup in the pace of consumer spending since last year. Q4 was kind of odd. Typically you get a lot of spending in Q4 because of holiday shopping and that sort of thing. Seems like in 2025 there was some kind of shift in some of the seasonal patterns where maybe spending happened a little bit earlier, so maybe it was registered in Q3, but Q4 was pretty soft. Q1, we saw a nice rebound, and now, more than 2 months into this conflict in Iran, and more than 2 months into this, higher gasoline price regime, consumers are really not showing too many signs of slowing down, and I think that it's going to continue at least through the end of the quarter. Hopefully, this is resolved relatively soon, and once gasoline prices come back down, then you have to imagine that you should be looking at an even better consumer picture for the second half of the year.
And if they continue to stay high, is that pressure finally going to be felt, do you think? Or
It's
really
hard to
felt?
say.
I mean, it's being felt now, but really felt?
Sure. Yeah. I mean, it's felt extremely unevenly across the economy, right? I mean, like the lower income households, or the plenty of very vulnerable households and people within the economy that are struggling to keep up with the pace of the increase in gasoline prices. But we spent the last couple of years talking about this K-shaped economy and how the upper income consumer is the one that's really driving the top line growth. Frankly, they don't really care that much about the increase in gasoline prices at these levels. If you want to try to look at inflation adjusted gasoline prices and think about what levels were like in a comparable period in 2008, for instance, that's the same as gasoline being up around like $8 to $10 a gallon. So we're not even close to the squeezy point where it starts to really affect everybody.
And just some of the individual numbers. Sporting goods leading the way. Is it spring and everybody went out and got new baseballs?
Could be, yeah. I mean, sporting goods is a kind of an oddity within the overall waterfall of retail sales, because lots of people bought tons of sporting good equipment, exercise equipment, that sort of thing during the pandemic lockdowns, and there's been this sort of like overhang of I don't really need to buy another one of those things type effect that has, led to sporting goods be quite weak for actually a couple of years. And just so happens that this month it was reasonably strong. Maybe people are buying bicycles because they don't want to drive their cars that take up too much gas.
And maybe the things they did buy are finally wearing out. They're having to replace them. And people also dining out and at the grocery store. And then is that more people dining out, or is that just paying more for the dining out?
Yeah, it's both. I mean, if dining out is interesting because I think that it's a, kind of there's a proclivity to say that might be where consumers start to pull back if their budgets are constrained. But I think that what we see time and again, as you look at different cycles and recessions, is that that's the kind of entertainment that people view as being relatively affordable. And even in times of struggle, people don't go down to absolute zero entertainment. They need something to kind of, keep the lights on. So, we see with the increase in prices, of course, you get a little bit of an increase in spending, but, that's been a consistent, it's been on a consistent path of growth. And then if we look at, food prices, in the recent inflation data, it's been a little bit choppy. I think eventually we are going to see some more food price inflation because food needs to move from place to place, and it costs, it ends up on trucks that generally take, diesel fuel. So eventually that price is going to need to translate into the tags on the shelf. But, for now, it looks like the price increases are relatively moderate, and there hasn't been a ton of signs of trade-off between, food at home versus going out.
And what are you looking for moving forward? And do things change with the new Kevin Warsh era?
I don't think things actually changed too much. I had been expecting that we were going to get some rate cuts with Warsh coming in, but given the improvement in the labor market data that we've seen so far this year, job gains on a monthly basis are averaging around 75,000 per month so far in 2026, which is a market increase from the 10K increase, per month increase that we saw in 2025. It seems to me that it's a more difficult case to make that interest rates are really all that restrictive. And given what we've seen in the recent inflation data, even though we expect that it's going to reverse once this conflict is resolved in Iran, just for now, it seems like that's a much more difficult case to make for rate cuts. So we may still get a couple towards the second half of the year, but that's dependent on the labor market kind of running out of gas a little bit. Doesn't seem like there are too many signs that that's actually happening, and inflation reversing in short order. So possible we get there, but maybe we're looking at rate cut adjustments in 2027 instead.
Okay, we'll wrap it up there. Thomas, thanks as always for joining us.
Of course, thank you.
Thomas Simons, Chief U.S. Economist at Jefferies. Coming up, today's market drivers with Bloomberg's Monique Malima. Time now to take a look at today's market movers. And for that, we're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. Let's get right to it. Canadian Solar, their first quarter results, top Wall Street estimates, but having a little bit of a drop right now.
Yes. So Canadian Solar, they reported revenue and margins that beat estimates, but this was largely driven by a one-time U.S. tariff refund that the company received. So analysts say that it doesn't really provide much read-through to future quarters. And while the revenue did beat, their loss per share actually widened compared to a year earlier. So they are still facing quite a number of difficulties with the solar market currently in North America. And analysts note that there's also some other factors weighing on the company as well. They've been burning through quite a bit of their free cash, and they're expected to continue to face some of those larger macro pressures going ahead. While the company did maintain their guidance, analysts say that this puts a lot of pressure on the second half of the year. They're going to have to really start to show some more improvements.
All right. Canada Goose, I think, was thankful we had a cold winter by the looks of it.
Yes, Canada Goose, their earnings beat and their shares have been trading higher off of that, their revenue beat, and they've been trading higher off of that this morning. We saw that they saw a big boost in wholesale revenue, which really helped to push their sales up for the quarter. And while their earnings per share did miss, analysts are really optimistic on the outlook for the company. Canada Goose reinstated a guidance for fiscal year 2027, which is their upcoming fiscal year. And they note that this is really positive because we're going to see higher margins. The Canada Goose is projecting 11 to 12% margins. They're projecting revenue growth as well. So the outlook is strong for this company, and that's why we're seeing the shares up.
All right, yeah, and the markets can make liars of us sometimes. The shares in the last 20 minutes or so have just dropped into the red right now. But most of the morning they were up, so we'll see what happens for the rest of the day. Last one, Berg Construction is helping out our parent company.
Yes, so Bird Construction, their shares traded higher this morning after Bell Canada announced that they are going to be their construction partner for a 300 megawatt data center in Saskatchewan. This will be one of the largest AI data centers in Canada, and that Bell also agreed with Bird to work together on future data centers across Canada. So there's a lot of momentum right now for this company. We've seen a lot of growth in the data centers, and we're going to continue to see them benefit from this. And with this deal, Bell also took warrants of some of Bird's shares. So that's why we're seeing the shares trade higher this morning.
All right. And of course, Bell is our parent company. Monique, thanks as always for joining us. Appreciate it. Bloomberg's Monique Malima. Just ahead, Birchcliff Energy reported its first quarter earnings last night. We'll get more from the president and CEO on the company's performance. That's next. Canadian home sales edged higher in April as lower prices and the arrival of the spring housing season brought more buyers into the market. According to the Canadian Real Estate Association, national home sales rose 0.7% from March, while the benchmark home price slipped 0.1%, the slowest monthly decline since October. New listings also climbed more than 4%. Shares of Canadian Tire are in the red by about 2% after the retailer posted second quarter results that came in weaker than expected. Softer consumer spending weighed on overall sales at its core retail business, resulting in revenue and profit both missing analysts' expectations. Same-store sales also saw a decline. Canadian Tire says sales growth at Sport Chek and Mark's helped offset weakness at its flagship Canadian Tire division. Shares of POA Technology soaring right now. They're up 32%. The Canadian producer of semiconductor chips has secured a milestone purchase order from Lumilens valued at $50 million US. Under the deal, POA will provide the computer hardware manufacturer with its high-speed optical engines. The 5-year framework agreement could also see Lumilens take delivery of components worth up to $500 million based on AI demand. And the rally continues. You can see the TSX actually gaining strength through the morning. It's up by 0.65% right now. Pretty much all the sectors are in the green. And south of the border, similar situation. Look at some of the numbers there. You've got the S&P 500 up over 7,500, up by 0.87. The Dow is back over 50 for the first time in a couple of months, and the NASDAQ just surging again. It's up more than a point. We've been watching shares of Birchcliff Energy today after the Calgary-based oil and natural gas company reported its first quarter profit and revenue rose year over year. You can see it's up 3.7% right now. And we sat down for more on this with Chris Carlson, president and CEO of Birchcliff.
So our first quarter cash flow was really strong. We actually had about $153 million of cash flow against spending of about $107 million. So the cash flow was really driven by a few things. First is strong production. Second being our gas market diversification. So we have access to premium markets in Dawn and NYMEX that represents, 56% of our gas, and also on the back of lower costs. So I think when you put those three things together, we were able to generate strong cash flow in the quarter. And when we spend $107 million, we actually generated free cash flow. And so we were able to use that $45 million of free cash flow to essentially pay our debt down by 8%. So our debt at the end of the year was $460 million. Today it's $423 million, and also pay our dividend to our shareholders of about $8 million. So strong quarter, largely on the back of our gas marketing diversification and lower costs. And then as we look forward, we're really excited about what's to come. And unfortunately, with the war in Iran, that's definitely an unfortunate part. The reality, though, is when you close the Strait of Hormuz, you're seeing oil prices increase significantly. And so notwithstanding Birchcliff is a gas company, we have 16 to 18% of our production mix is oil, liquids, and natural gas liquids. So the reality there is we are benefiting, notwithstanding we're a gas company, we are benefiting from the strength in oil prices as well. And so we've increased our cash flow guidance for the year to $455 million. And that means we're going to generate more free cash flow as well this year. So, as we think about the back half of the year, again, we're going to fill up our infrastructure that is sitting there. Today, we have all these fixed costs in our business. We get to utilize that infrastructure, and that will really drive down our per unit costs and really have a rate of change story when you think about the amount of margin expansion we can get by filling existing infrastructure, and the cost structure improves into the end of the year and into 2027.
As you mentioned, you flagged strong oil prices moving forward, but weak AECO gas. And given how much you're weighted in gas instead of oil, how concerned are you about that side of things?
Yeah, so AECO gas, I know there's certainly disappointment, us included, in terms of where the AECO price is. I think the reality of a lot of Canadian gas producers is we've had to diversify over a number of years away from AECO. And so if you look at Birchcliff specifically, we would have, 56% of our gas production is sold in U.S. markets. So our exposure to AECO is 40 to 45% of our gas stream. So just on a gas basis, we've got significant diversification that reaches NYMEX-based pricing and Dawn pricing in Southern Ontario, which were really strong in Q1 and look to be, I'd say, quite reasonable as you move out into the back half of the year. And Dawn storage levels specifically, because it was so cold out east at wintertime, the draw on the storage levels at Dawn was, I want to say record, but it hasn't been this low for a number of years. So the demand for gas out east to fill that storage back up leading into the next winter will continue to drive stronger prices out east, which is where we sell a good chunk of our gas. And then in addition to that, you referenced the liquids. I think it's underappreciated. Some of the Montney companies, us included, that have 16 to 18% of our production mix is liquids. And so we will benefit from stronger oil prices and stronger propane prices and butane prices and all the other liquids we produce along with that gas.
Your production guidance, though, remains unchanged. Why not raise it?
Yeah, so I think the production is on track in terms of where we're at. So today we're going through a turnaround at our major facility out at Puskapay. That will be done here by mid-end May. And then after that, just the way that the capital program is laid out, we're drilling wells throughout the year and we add production into the back half of the year to fill up that infrastructure. And so today we're actually just starting on our liquids weighted part of the program. And that's historically because summer gas prices have notoriously been weak. So we'll drill our more prolific, drier gas wells at the beginning of the year. And then as we move into the summertime, we're now marching ahead with our liquids rich and oil program into the summer. And that will then drive strong economics as we fill up that existing infrastructure near the back half of the year. So I think everything is going as per plan, and we'll see where we end up in the back half of the year with respect to production.
So we talked about some of this already. You're reducing debt, buying back shares, and paying a dividend. Of these three, first of all, what's your top priority, and what can shareholders count on if things do become more challenging in the future?
Yeah, so for us, our goal this year is to fill up that existing infrastructure. We get a huge benefit in terms of our cost structure. So we improve our net back by $1.15 to $1.25, which translates into 2027 free cash flow of an additional $50 million. We also improve our margins at that gas plant and through that infrastructure by about 8%. So that's priority one. Is in this intermediate period this year, we're looking to fill up that infrastructure. We'll continue to pay our debt down and pay that sustainable dividend. That's been the mantra, and that is the strategy moving forward. That continues. However, we have been opportunistic with the NCIB or the share buyback. And so you saw subsequent to Q1, when all the funds, institutional funds moved into the oil companies with the war in Iran, the gas companies, us included, were sort of left behind, to be honest. And our multiple and our value fell way below our intrinsic value. And so that was an opportunistic purchase or an opportunistic time for us to step in and buy the shares because we think they're significantly undervalued.
Lindsay was speaking with Chris Carlson, President and CEO of Birchcliff Energy. Coming up, credit unions in Saskatchewan and BC saw a rebound last year. We'll break down the trends next. Credit unions across Saskatchewan and BC have rebounded last year after interest rates eased off their 2023 peak. For more on what's driving the turnaround, Josh Veenkamp, Assistant Vice President of North American Financial Institution Ratings at Morningstar, joins us in studio. Always a pleasure to have people in studio. Thanks very much for joining us, Josh.
Thanks for having me.
Okay, so what's been leading the turnaround? Where's the drive coming from?
For sure. So just for a very quick context, at Morningstar DBRS, we rate the three largest credit unions in Saskatchewan and the three largest in BC. So we now have 2025 results for all six of them. And we've seen continued steady growth in Saskatchewan. And in BC, really a meaningful recovery in earnings coming off a weak 2023 and 2024. And really the driver is the same across the board. So margins are improving on lower funding costs. And then we're also seeing higher non-interest income, which is largely wealth management income on the back of strong equity markets.
And which of them were showing the strongest bounce back?
So BC is really the one bouncing back. Saskatchewan they didn't see the same downturn in earnings, so they've been more steady.
More steady, and within the credit unions themselves.
Yeah, so it varies. Saskatchewan, again, they've all been pretty steady. So in BC, the two that have rebounded that saw the biggest hit in the past couple of years were True Cooperative Bank, which is formerly known as First West Credit Union, and then also Van City. And Coast Capital, the third one, they've been hit less on that side, and so there's less recovery to be seen there.
And it is very much a Western thing, isn't it? The credit unions. How do they compare to the banks? And
yeah, so
just kind of in general, and what's the appeal out there to them?
Yeah, certainly they have larger market shares out there, and I think you see that as maybe historically because the banks started in the East and they didn't make their way there as quickly, so the credit unions had time to grow there. Certainly compared with the big banks, the credit unions are much, much smaller. They wouldn't offer the same breadth of products. The credit unions largely don't play in the capital market space that the big banks do. But I think we're really seeing the credit unions seeing an opportunity in kind of the mid-sized banking space, just because you've seen some of those players swallowed up by the big guys. So Canadian Western acquired by National, HSBC Canada acquired by RBC. Now we're seeing Laurentian going to Fairstone. So a lot of those mid-sized players have disappeared, and so the credit unions see kind of an opportunity there.
And they're all private, right? They're all private companies. Are any of them publicly traded?
The credit unions, no, they're not.
No, they're all
publicly
private.
traded.
And within them, Federal Credit Union, which is Saskatchewan, it had a flat net interest margin year over year. Any clear reasons for that?
Yeah, so Innovation, it's a Federal Credit Union, as you mentioned. They have had consistent earnings year over year, and they were already at the high end of peers, high end of margins for sure. And that's largely been driven by kind of this growth strategy they have. A number of years ago, they kind of decided to expand outside of the province to boost earnings, to diversify the loan portfolio. And so kind of those loans which are coming from third parties and in other provinces are higher yielding, so they've had higher returns. But on the flip side, we've seen some credit deterioration at that credit union as well.
And with the other credit unions, any concerns or strong points for them that stand out within the individual ones?
Really, it's been a broadly similar story across them. Like I said, this recovery in margin in BC, and then kind of just a steady growth in Saskatchewan.
And where do you see them heading over the next year?
Yeah, so earnings-wise, we see revenue growth continuing kind of on the same trends, margins recovering, and then as well, maybe some higher non-interest income from wealth. But we also do see headwinds in the space. Certainly, there's this lingering macroeconomic uncertainty, geopolitical tensions, maybe driving inflation, and then also really in the residential development space, there's certainly weakness there. So keep an eye on that.
Okay, we've got to wrap it up there, Josh, but thank you very much for joining us.
Thank you very much.
Appreciate it. Josh Veenkamp is Assistant Vice President, North American Financial Institution Ratings at Morningstar. Still ahead, we'll head to Beijing for the latest on Taiwan, taking the spotlight as Donald Trump meets with Xi Jinping. Stay with us. Canada is one step closer to getting a new pipeline that will transport Alberta crude to the West Coast. CTV News has confirmed a major piece of the puzzle has been addressed, but there are still many more steps to go. CTV's Ottawa Bureau Chief Graham Richardson reports.
After years of opposition and protest, pipeline politics are changing. What seemed entirely unlikely just 18 months ago is now one major step closer.
Are you willing to allow a new pipeline?
The Prime Minister not confirming it, but sources telling CTV News his government and Alberta are set to announce a deal on a new pipeline to the West Coast.
I think it's a great thing for the industry, and it's a great thing for Canada.
This is one part of a complex process, and it was telegraphed last week by Alberta Premier Daniel Smith in Ottawa.
sometimes it happens that you get the two principals in the room and you kind of sort through what some of the disagreements are. And I felt like we sorted through a lot today, had a meeting of the minds, and I'm hoping that we'll be able to announce an agreement very soon.
A key sticking point was the industrial carbon price rising higher each year. Sources say the Carney Liberals have agreed to slow the growth in the price significantly. Under the plan introduced in 2016, the carbon price was supposed to hit $170 per ton by 2030. Now that will be reduced and only hit $130 a ton by 2040.
Having investment in our own energy sovereignty. And I think in these circumstances, we need to adapt and we need to invest.
Some environmental groups would not openly criticize the shift, but they are clearly disappointed.
We've been suggesting that getting to $130 a ton for the Alberta industrial carbon price by 2030 was a reasonable and effective deadline. Instead, it looks like that's going to happen by 2040, fully a decade later. So that is disappointing.
Of course, hanging over all of this is years of acrimony between Alberta and Ottawa. Will this change all of that? Probably not, but it will be seen as one of the first positive steps in many years. Graham Richardson, CTV News, Ottawa.
Xi Jinping warned Donald Trump that Taiwan could lead to clashes between the superpowers, calling it a highly dangerous situation for the world's biggest economies. For more on this, we're taking you to Beijing now, where we're joined by Bloomberg's Anne-Marie Hordern.
Well, the timing we heard about was very interesting. President Trump and Xi Jinping were still in the bilateral meeting. We had just left them outside the Great Hall of the People, where Xi Jinping had a very warm welcome for President Trump. And then through the Chinese media, we got a readout that President Xi discussed Taiwan with President Trump and said if this relationship is mishandled, it could lead to potential conflict or a dangerous situation between Washington and Beijing. And then hours later, we got the White House readout, and there was no mention of Taiwan. Clearly, this White House wanted to focus on some of the wins, the agricultural agreements that they discussed potentially. And we are seeing some licenses for imports for beef from America into China already in a sign of goodwill this evening. On top of that, they discussed energy purchases as well as Iran. According to the White House readout, Xi Jinping said he doesn't want to see a militarized Strait of Hormuz. He doesn't want to see a toll. And the two agreed on making sure Iran doesn't have a nuclear weapon, but there's no mention of Taiwan. So, of course, that is why this has become really one of the major talking points of the trip, even though for the most part, and the two just had a banquet and had a toast together. President Trump invited Xi Jinping to the White House in September. Very warm ties, optimistic tones when it comes to business deals, but obviously there is still tension between this relationship when it comes to Taiwan. We should note, though, that that is not necessarily uncommon. All presidents, Chinese presidents, would bring this up in any meeting with the United States.
Okay, so maybe expected to hear a little bit more about that. So you mentioned there was trade discussed, maybe some trade deals. Iran was discussed. What about the CEOs that accompanied Donald Trump on this trip? We were talking about this yesterday. NVIDIA's CEO tagged along last minute. Boeing's CEO is there. Have you heard anything from any of these big names that went with Donald Trump?
Well, one of our colleagues spoke to Jensen Huang, who was talking about how everyone's watching this meeting. It was a fantastic meeting. And Reuters had a report that the United States had approved the sale of H200 chips to Chinese companies like Tencent and Alibaba. But we already knew that back in January when this administration made a U-turn to allow the H200s. The issue was China wasn't allowing their firms to buy them. So I think going into tomorrow, that's going to be a critical question. Has China lifted some of these holds they have, blockades, if you will, on a number of issues that the United States actually were allowing? So I think that's something we're going to be on the lookout, especially as the two might discuss some sort of technological channel to discuss artificial intelligence.
And Lindsay was speaking with Bloomberg's Anne-Marie Hordern. And market calls coming up next. Today on the show, we have Stan Wong. He's portfolio manager at Scotia Wealth Management. He'll be taking your questions on North American large caps and ETFs. All right, let's take a look at the markets And it is another green day for everyone right now. You can see the TSX is up by 0.63% right now. And pretty much every sector is in the green, save for materials. It's up by about 1.6. Tech leading the way. It's up by 2.2. And some of the companies worth talking about right now, Bird Construction, shares there are still up about 4%. At one point, they were up more than 8%. With the news that it was announced it was the contractor that was selected by Bell Canada to lead the construction of the 300-megawatt AI data center in Sherwood, Saskatchewan. And Bird has also formed a long-term strategic partnership with Bell for a multi-year Canada-wide AI data center build-out. And of course, Bell is our parent company here at BNN. And so you can see Bird Construction is reacting nicely. Brookfield Corporation, another one making the news today. And what's it doing now? Okay, it's up about 6.8% on its earnings reports. Strong first quarter. But it also is saying, it's also put out today that it owns $2 billion of pre-IPO shares of Elon Musk's SpaceX, with half of it on its parent company's balance sheet and the rest held by other affiliated entities. So we'll see what happens with that. And then let's take a look south of the border. And Wall Street, similar situation. Look at some of those numbers. The S&P 500 above 7,500. It's up by nearly a point. The Dow Jones, again, up over 50,000 for the first time in a couple of months, up by 0.9%. And the NASDAQ is up by more than a point in record territory. Same for the S&P 500. And one of the big movers today, Cisco. Take a look at what it's doing. It's up 15%. At one point, it was up 17%. After it reported third quarter results that beat expectations and also raised its full year forecast, extending gains for a sixth consecutive session. And just want to quickly get to Ford. It's in the middle of a very nice rally right now. And a lot of that, they announced that they're getting into the energy storage sector, and that's what's surging on it. That's what's making it surge. That's it for Morning Markets. We'll see you tomorrow.